I've watched fortunes rise and fall like tides, predictable only in their certainty to change. The markets have been my classroom for decades, teaching lessons written in the ink of profit and loss. Bitcoin, when I first encountered this digital phenomenon, I recognized something familiar in its volatile nature, the same patterns that have governed all markets since men first gathered to trade. The difference isn't in the asset, it's in the investor, discipline. This single quality has separated the survivors from the forgotten throughout market history. I've made and lost millions several times over, and each cycle taught me the same truth. The market doesn't reward intelligence alone, nor does it favor the merely brave. It rewards the disciplined. When Bitcoin surges 20% in a day, I don't see opportunity, I see human nature at its most vulnerable. Greed mounting, fear subsiding, the precise moment when most traders abandon their systems and chase emotion. I learned to recognize these moments because I've been consumed by them myself. The market has no mercy for those who cannot control their emotions. It doesn't care about your hopes or your needs. It simply responds to supply and demand, fear and greed, moving with the cold precision of nature itself. My greatest losses came not from poor analysis, but from moments of weakness when I allowed excitement to override my trading rules. My greatest gains came from periods of unwavering adherence to principles, even when every headline, every friend, every instinct screamed otherwise. Bitcoin is merely the latest stage on which this timeless drama plays out. New technology, same human psychology. The winners will not be those who understand the blockchain best, but those who understand themselves, those who can stand firm when others panic, who can stick to their strategy when excitement builds, who can maintain their discipline when the world loses its mind. This is not merely investment advice, this is survival knowledge, earned through decades of triumph and heartbreak in the unforgiving arena of the markets. I still remember my first significant Bitcoin position. The market had been bleeding for months, the kind of sustained pain that drives most retail investors to swear off the asset class entirely. Every day brought new predictions of failure, new critics emerging from the woodwork. Digital tulips, they called it, a Ponzi scheme. The same dismissive language that accompanies every paradigm shift. But risk isn't found in price, it's found in behavior. I wasn't risking capital on a speculative asset. I was applying the same timeless principles that had served me across decades of traditional market cycles. The asset class changes. Human nature doesn't. My routine remained unchanged. Each morning I reviewed the same indicators, the same support levels, the same volume patterns. While others scrambled to find meaning in every tweet, every regulatory announcement, I maintained a posture of patience. The disciplined trader doesn't chase news, they wait for the market's response to news. This consistency isn't glamorous, it doesn't make for exciting conversation at dinner parties. Most days my actions in the market are invisible because most days the correct action is to do nothing at all, to observe, to wait, to allow your strategy time to work. I've watched young traders enter the Bitcoin market with brilliant minds and sophisticated models, only to be crushed by their inability to control their emotional responses. They mistake information for wisdom, confusing the ability to understand the technology with the discipline required to trade it profitably. When Bitcoin dropped 70% from its peak, I didn't panic. I'd seen this movie before, played out across different assets, different decades. Markets overextend in both directions. The underlying adoption continued its steady climb even as price cratered. My position size had been determined in advance, sized appropriately so that even a complete loss wouldn't jeopardize my overall financial health. This is what emotional control looks like in practice. Not the absence of fear, but the management of it. Not blind confidence, but reasoned conviction paired with rigorous risk management. I'm often asked what separates the successful Bitcoin investors from the casualties. Is it technical analysis skills, fundamental understanding, network connections? While these all matter, they pale in comparison to the investor's relationship with time. Those who approach Bitcoin with patience, who can think in terms of years rather than days, have already eliminated their greatest competitor, their own impatience. The market rewards those who can endure its lessons, who can absorb its teachings without being broken by them. Behind every overnight Bitcoin success I've encountered, I've found years of quiet study, of small positions grown gradually, of lessons learned through both profit and pain. Success in this market isn't about timing the perfect entry, It's about developing the character required to survive long enough to be right. The most profound lesson Bitcoin taught me came during its darkest hour. After reaching nearly $20,000 in 2017, I watched it decline for over a year, eventually bottoming around 3,000. The financial media had written its obituary. Former enthusiasts became critics. The halls of trading forums, once bustling with excitement, fell silent. It was during this winter that I recognized something I'd seen many times before: the natural selection process that every significant market innovation undergoes. This wasn't just about price, it was about conviction, about understanding what others couldn't yet see. I increased my position, not because I could predict the future, not because I had secret information, but because my system, built on decades of market discipline, signaled an opportunity while emotions signaled danger. The greatest investments of my life have always come when these two forces stood in opposition. Risk isn't measured in volatility or price fluctuations. True risk lives in the gap between your strategy and your behavior. How wide is that gap for you? How easily do external voices, media headlines, friends' opinions, social media sentiment penetrate your decision-making process? Every time you deviate from your predetermined plan, you introduce the most dangerous element in investing: inconsistency. I've studied the trading journals of hundreds of failed Bitcoin investors. Their strategies on paper often appeared sound. What failed wasn't the strategy but the execution. A buy order canceled because of a negative news cycle. A position size too large during a moment of excitement. A carefully chosen entry point abandoned because of impatience. Death by 1,000 small compromises. Consistency requires something most aren't willing to give: the acceptance of missed opportunities. There will be rallies you don't participate in. There will be perfect entry points you observe only in retrospect. The disciplined trader doesn't chase what's already moving. They wait for setups that match their criteria, even if that means periods of inactivity. I recall sitting with a young Bitcoin trader during the 2018 bear market. Brilliant mind, deep technical knowledge, yet his account had been decimated not by his analysis but by his inability to stick to position sizing rules. I knew it was going higher, he told me, so I went all in. The cemetery of market history is filled with traders who were right about direction but wrong about risk management. Emotional control isn't the suppression of emotion, it's the channeling of it. Fear becomes caution, excitement becomes thoroughness. The disciplined investor harnesses these emotions rather than being controlled by them. When Bitcoin eventually began its recovery, climbing from $3,000 to over $60,000, I didn't feel vindication. I felt reinforcement of a principle I've observed across every market cycle: assets may change, but the behavior that surrounds them doesn't. The same emotional patterns that governed railroad stocks in the 1900s govern digital assets today. Different stage, same human drama. My routine remained unchanged through Bitcoin's meteoric rise. Same morning analysis, same position sizing rules, same risk parameters. Many mistook this period of extraordinary returns as validation of reckless approaches: buying on margin, ignoring diversification, abandoning risk controls. They confused a rising market with personal skill. This is always a costly error. I've weathered enough market cycles to recognize the signs of speculation detaching from fundamentals. When taxi drivers began offering Bitcoin tips, when mortgage-backed home equity lines were being used to fund crypto portfolios, when every conversation at social events turned to which coin will be the next Bitcoin, my system began flashing warnings. I reduced exposure not to zero but to levels consistent with my risk tolerance, not because I could predict the exact top but because discipline demanded respect for the patterns unfolding. The same rules that guided my buying guided my selling. Consistency requires symmetry in both directions. When the inevitable correction came, I watched fortunes evaporate overnight. Social media accounts that had boasted of genius investing acumen suddenly fell silent. Self-proclaimed experts disappeared. This too was familiar, the same pattern I'd witnessed in 1929, in 1987, in 2000, in 2008. Different assets, same human behavior. What separates long-term success from momentary luck is the ability to survive these cycles, not just financially but psychologically. The market doesn't just take money, it takes confidence. It destroys conviction. It plants seeds of doubt that bloom into abandonment of strategy just before strategy would have paid off. My most valuable Bitcoin positions weren't those purchased at the lowest prices, but those I managed to hold through multiple cycles, through periods when selling seemed like the only logical choice, when every voice around me suggested capitulation. Patience isn't passive, it's an active discipline requiring constant reinforcement. I've been asked countless times for my Bitcoin price prediction. Will it reach 100,000, 1 million, 0? These questions miss the point entirely. The disciplined investor doesn't bet on specific outcomes. They position themselves to benefit from probable scenarios while protecting against improbable ones. They focus not on what they can't control, price, but on what they can, their response to price. Results in this market come not from prediction but from preparation, not from timing but from positioning. The investor who survives long enough eventually benefits from being approximately right rather than precisely wrong. The most dangerous period in any Bitcoin investor's journey isn't during the crashes, it's during the euphoria, when paper profits create the illusion of invincibility, when the market seems to reward every decision regardless of its quality. This is when discipline faces its greatest test. This is when most abandon the very rules that brought them success. I've maintained the same position sizing model throughout Bitcoin's existence, never risking more than I could afford to lose entirely. This wasn't pessimism, it was pragmatism. It wasn't lack of conviction, it was respect for uncertainty. The most confident swimmer still wears a life vest in unknown waters. The greatest challenge in Bitcoin investing isn't technical analysis or fundamental valuation. It's maintaining your identity as markets swing from despair to euphoria and back again. Who are you when your position doubles overnight? Who are you when it halves? Are you the same investor following the same principles? Or do you shapeshift with the market's mood? Discipline isn't a tactic, it's a character trait. It's not what you do, it's who you are. The Bitcoin investors who have created genuine sustainable wealth aren't those who caught a lucky break on timing. They're those who approached each day with the same principles, the same process, the same respect for risk, regardless of what price did the day before. I don't know what Bitcoin's ultimate value proposition will be. I don't know which technological iteration will prevail. But I know with certainty that those who approach this market with discipline will outlast those who don't. The asset may be new, but this truth is as old as markets themselves. I've come to view Bitcoin not just as a technological innovation, but as the ultimate mirror reflecting back to each investor their relationship with uncertainty. Some see in its volatility a casino, others see a revolution. I see a testing ground for timeless principles. Throughout my career, I've developed what I call the paradox of the disciplined trader. The more rules you faithfully follow, the more freedom you ultimately experience. Freedom from doubt, freedom from regret, freedom from the psychological toll that comes from inconsistent decision-making. My personal routine has remained largely unchanged since I first entered the markets decades ago. Each morning begins with the same ritual: reviewing positions, checking key levels, updating my journal. This consistency isn't merely about organization, it's about creating an environment where discipline can flourish. Chaos breeds impulse. Structure nurtures. I've witnessed brilliant minds enter the Bitcoin space with sophisticated models and deep technical knowledge, only to be crushed by the weight of their own emotional responses. Intelligence without discipline is like a powerful engine without brakes, impressive until the first sharp turn. The long-term trajectory of any investment career isn't determined by occasional brilliant decisions, but by the avoidance of catastrophic ones. I've survived while others haven't because my worst days were contained by rules established during my clearest thinking. Your risk management system must be built during periods of emotional neutrality, then followed during periods of emotional intensity. Bitcoin's extreme volatility has claimed countless victims, not because they were wrong about its potential, but because they couldn't endure the psychological journey required to realize that potential. The path to significant returns isn't a straight line, it's a psychological gauntlet designed to shake you out before the real movement occurs. I'm often asked what percentage of my portfolio I allocate to Bitcoin. This question reveals a fundamental misunderstanding of disciplined investing. My allocation isn't static, it's responsive, increasing when risk is appropriately priced, decreasing when speculation dominates. The percentage matters less than the process used to determine it. The most valuable skill in navigating Bitcoin's cycles isn't technical analysis or fundamental research, though both are important. It's the ability to distinguish between market narratives and market realities. The narrative is what everyone believes. The reality is what's happening beneath the surface, revealed only through patient observation and disciplined interpretation of data. There's a particular moment that repeats in every Bitcoin cycle when early adopters face immense social pressure to sell. Friends and family question their judgment. Media headlines suggest the end has come. The temptation to capitulate becomes nearly irresistible. I've watched countless investors break at precisely this point, selling assets that would have secured their financial future had they maintained their conviction for just a while longer. This is perhaps the cruelest feature of markets. They tend to validate your strategy only after testing your commitment to it beyond what seems reasonable. The greatest returns often come just after the point of maximum doubt. This isn't coincidence. It's the natural selection process of markets at work. I don't claim perfect foresight. I've made significant errors throughout my Bitcoin journey, but these errors were contained within a framework of risk management that ensured no single mistake could devastate my financial position. This isn't about avoiding all losses, it's about ensuring survivability. You cannot compound returns if you're eliminated from the game. If there's a secret to my longevity across market cycles, it's this. I've learned to separate my identity from my positions. My self-worth isn't tied to being right. My sense of self doesn't rise with my account balance or fall with my losses. This emotional detachment isn't callousness, it's clarity. It allows me to change direction when evidence demands it, without the ego-driven resistance that destroys so many promising careers. The greatest Bitcoin investors I've known share this quality. They hold strong convictions loosely. They're willing to be proven wrong. They adjust to new information without abandoning core principles. They maintain the delicate balance between conviction and flexibility that all successful investing requires. As I look back on decades in the markets, I recognize that the most important decisions weren't about what to buy or sell, but about how to conduct myself during moments of extreme uncertainty. The true differentiator wasn't strategy but temperament, not intelligence but patience, not information but interpretation. Bitcoin will continue its volatile journey long after my time in these markets has ended. New narratives will emerge, new champions and critics will stake their claims, but beneath these shifting sands, the bedrock principles of disciplined investing will remain unchanged, just as they have through every market innovation, every technological revolution, every paradigm shift I've witnessed throughout my career. If you take nothing else from my experience, remember this. The market doesn't reward you for activity, it rewards you for correct activity. It doesn't reward complexity, it rewards effective simplicity consistently applied. It doesn't reward excitement, it rewards emotional control maintained precisely when excitement threatens to override judgment. The greatest wealth is built not in the frenzy of bull markets, but in the quiet accumulation during periods when others have lost interest. Not in predicting unpredictable outcomes, but in positioning yourself to benefit from multiple possible futures while protecting against catastrophic ones. Not in timing perfect entries and exits, but in sizing positions appropriately so that time becomes your ally rather than your enemy. This is the invisible price of discipline paid daily in the currency of restraint, patient observation, and humble learning. Few are willing to pay it consistently. Those who do find that the market eventually returns this investment many times over, not just in financial rewards, but in the priceless confidence that comes from knowing you've mastered the most challenging opponent you'll ever face in these markets, yourself.